In addition to unusual or infrequent items and our discontinued operations, we can also have restructuring charges. So we might have losses when we write down the amount that our plant assets are worth, when we sell plant assets, when we pay for, if we have severance pay for terminated or laid off workers, relocation of operations and or employees. These items get shown on our income statement as single items unless they involve discontinuing a segment. Then those expenses are shown as part of the discontinued operations that we just looked at. Now we're going to talk about common stock and information about common stock. So the first thing that we look at is earnings per share, or EPS. So this only applies to common stock. So preferred stockholders have no claim to earnings beyond their preferred stock dividends. So earnings per share is our common stockholders' share of the company's net income divided by our average number of common shares outstanding. Now the calculation of the average number of common shares outstanding is extremely difficult, and you're not going to be required to do it as part of this class. One of the reasons that it's difficult is that in order to determine the average number of shares outstanding, you have to know on exactly which dates shares were sold and how many days of the year they were outstanding, etc., in order to determine that. Because of this, most companies just give you the earnings per share amount as part of their income statement. They have their income statement, it shows their net income, and then they add a line at the bottom that says the common stockholders' EPS is this. So, as I said before, it's easy to determine if the number of outstanding shares did not change during the entire year. However, if it did change, then we have to do a lot more calculations. In this example, we have a company that has 80,000 shares of common stock outstanding during the first 9 months of the year. We then sold an additional 60,000 shares, so that 140,000 shares were outstanding during the last 3 months of the year. Our company's net income for the year was $250,000. We want to determine what the earnings per share was. So we have to figure out what the weighted average number of common shares outstanding was. So what we do is we take those 80,000 shares. We have 80,000 shares outstanding for 9 of the 12 months. So if we take 80,000 shares times 9/12, we get 65,000 shares. Then we take the 140,000 shares we had outstanding for 3/12 of the year, or 3 months. That gives us 35,000 shares. So our weighted average shares outstanding is 95,000 shares. Sorry, this is 60,000. If our net income was 250,000, we take 250,000 divided by our 95,000 shares, and we calculate an EPS of $2.63, earnings per share. When a company has preferred stock, the preferred stockholders get net income only to the extent of the preferred stock's stated dividend. So then we have to subtract any preferred stock dividends from our net income in order to determine how much income is left over for the common stock. So the annual dividend is always deducted, even if it's not declared. And if we have dividends in arrears, we're only going to take the current year's dividend because we're just looking at the current year's net income. We would only have to take other dividends if they had been declared to be paid. So we have an example with preferred dividends. We have 200,000 shares of common stock and 12,000 shares of 6% cumulative preferred stock outstanding. We have net income of $595,000. So the first thing that we have to do is we have to determine how much of that goes to our preferred stockholders in the form of dividends. So we're going to take those 12,000 shares times $6. That tells us that they get $6 per share of stock. That's $72,000. So we take our $595,000 net income, subtract the $72,000 in preferred stock dividend, and that tells us that we have $523,000 of earnings applicable to common stock. We take that $523,000 and we divide it by our 200,000 shares of common stock. That gives us an EPS, earnings per share, of $2.62 per share. Publicly owned corporations are required to present EPS figures in their income statements, as I said before. So the income statement, if it shows discontinued operations, then the per share figures are shown for both income and from continuing operations and just their normal net income. They might also have something that's called diluted earnings per share, and we'll talk about that in just a minute. So basic earnings per share is based on the weighted average number of common shares throughout the year. Diluted earnings per share, that also looks at the impact if we have instruments that can be converted into stock. So some bonds can be converted into stock. Additionally, sometimes we might have preferred stock that gives an option for the preferred stock owners to turn it into common stock. And stock options are a corporate benefit given to employees that instead of a cash bonus, they're given the ability to take on so many outstanding shares of stock without paying money for them. So any of these things would include the number of shares outstanding if they happen. So if an employee takes their stock options, we're going to increase the number of shares outstanding. So that is called diluting the number of outstanding shares. This is company information that they have, so this is one of the other reasons that they have to show that on their income statement if they're publicly traded companies. You don't know how many bonds they have outstanding and how many outstanding common stock could potentially be turned into. So it's hard to determine how many potential shares outstanding they could have. So they're just required to give you that information. Let's move